if you're retired, you're still likely going to be liable for capital gains tax on the sale of an asset, maybe an investment property, some shares, share portfolio, whatever it might be. Capital gains tax is still an issue, still a consideration, but because most people, when they're retired, their income is a whole lot less than what it is during their working life, the resulting tax liability, the resulting capital gains tax liability, is often far less in retirement than what it might have been during someone's working life. Let me explain with a diagram. So let's start with, you've got some income from work. Now, if you sell an asset and you make a gain, if you've owned that asset for more than 12 months, only half of that gain will count as income. So if we draw a line through here, this part counts as income. What actually happens in terms of tax implications is the gain that you've made here gets added on to the income that you might have earned from work or any other sources, and then you have to pay tax on all of this income. If this part's come from work, your employer would have deducted the appropriate amount of tax, but no tax has been paid on this gain, so you'll end up with a tax bill for the tax that's liable on the gain. Now, if instead you're selling this asset when you're retired, you might still make that same gain. Half of it, if you've owned that asset for more than 12 months, counts as income. But because you're no longer working, you don't have this base level of income that the gain is added on top of. Instead, you just have this half gain here that you've got on the sale of the asset, and then you just pay tax according to this income because you haven't got the base income of which your gain is added on top of. Now we can take this a step further. If you're also under the age of 67 and you're not working anymore, you might also be able to make a tax deductible contribution to superannuation to reduce the assessable amount of this gain down even further. What I'm talking about is inside of superannuation, or via your super rather, you can contribute up to $27,500 per annum on what's called a concessional contribution or a pre-tax super contribution. Now, if you are retired, you're no longer working, you don't have this income going in, you won't have contributions being made to superannuation by an employer for you. If instead though you made a gain over here, and let's say for example you've got $100,000 worth of assessable gain that you're going to have to pay tax on, what you could do is use some of that money to make this contribution over here, $27,500, so you'll get a $27,500 deduction against this income that you have. So instead of having to pay tax on $100,000 worth of gain, you'll have to pay tax on $100,000 less the super contribution that you've made over here. You'll only have to pay tax on $72,500. Now this contribution over here is taxed at 15%, but you're going to save a bit of money.